Today is Tuesday, May 19th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Mark Bowman, ADMIS Senior Market Research Analyst, and JP Steiner, ADMIS Associate Economist. Starting with the grain markets this morning, Mark, what are your expectations for this afternoon's crop progress reports?
Well, rains last week likely limited planting activities in the northern plains and portions of the eastern corn belt. However, I think good progress was likely made in the western corn belt and areas in the central Midwest, namely Illinois and Iowa, the two largest corn and soybean producing states. I look for corn plantings to have advanced to around 77-78%. That's up from 62% last week and would compare to 67% a year ago and the 5-year average of 73%. So staying just ahead of its historical average there. On beans, I think plantings likely reach 64-65%, very close to its record pace of 65%. And that would compare to 50% a year ago and a 5-year average of 54%. Spring wheat seedings likely slowed again because of the rains across some of these northern plain states. However, I still think seedings did advance roughly 10% to 76% complete. That would match the pace from a year ago and staying well ahead of the 5-year average, which fits in this week at 65%. So the first hurdle in order to obtain strong yielding crops is to get that crop in the ground. Looks like we are accomplishing that relatively quickly here, at least in the corn. And I do look for winter wheat ratings to probably hold pretty close to steady, 54% good to excellent.
And Mark, what does the commitment of traders report look like for the grains currently?
Well, money managers, they just keep piling in on the short side of the wheat market. Friday's commitment of traders report showed money managers' short position in Kansas City wheat expanded another 8,500 contracts, expanding that record short position out to about 81,000 contracts. Money managers also pretty big sellers in Chicago wheat as well, selling another 13,000 contracts. That short position now is out to 127,000 contracts, and that's the biggest in nearly 2 years. Add them all up between Kansas City, Chicago, and Minneapolis, that short position is a fresh record large short position at 235,000 contracts. Prior to just a couple weeks ago, the record short position wasn't even 200,000. So from a historical perspective, they're really pushing it on the short side here. Still lacking a spark to ignite a full-blown short covering rally, but with prices historically low, speculators historically short, at some point, I think they've got to start thinking, how much more money can they be making staying short wheat? And in the long haul, short prices will cure the low prices will cure the low prices. In corn, money managers also big sellers, adding about 99,000 contracts on the short side, flipping that position now to net short for the first time in nearly 7 months. Money managers, they were moderate buyers here across the soybean space last week. That said, however, they still remain near record short here in the meal and a little bit of a long position in both beans and in oil.
Thanks, Mark. JP, what are the key economic reports that traders should be gearing up for this week?
So compared to last week, it's a relatively light week for economic data in the U.S., so focus in the markets will shift to any headlines surrounding trade news and any trade developments. However, there are several notable economic reports coming out this week. In addition, there are going to be several speeches from Fed members that investors will be listening to, although any change in tone from expectations is unlikely. U.S. weekly jobless claims data is due at 7:30 a.m. Central Thursday. Expectations are expecting around 227,000 claims. Last week saw claims unchanged at 229,000. We'll also get U.S. manufacturing and services PMI data Thursday at 8:45 a.m. Central. Manufacturing PMI for the month of May is expected to come in at 49.9, which would indicate a slight contraction in manufacturing activity in the U.S., whereas the previous figure was 50.2. So we'll be waiting for that Thursday. Services PMI for the month of May is expected to come in at 50.7, which would indicate a slight increase in activity April's figure was 50.8, so not too far off from the mark. However, we will be waiting for those figures. Existing home sales data will be published later Thursday at 9 and is expected to show an increase in sales, with economists expecting 4.15 million new home sales. The previous figures showed 4.02 million home sales. New home sales for the month of April will be released at 9 a.m. Central Friday, and I would pay close attention to this figure as it could have major implications for the labor market. Economists are expecting new home sales to be 696,000, which would be lower than the previous reading of 724,000. Now, recently, high mortgage rates and the impact of tariffs have created headwinds for the construction industry, as higher rates have dampened new demand for new home sales, and tariffs have threatened the industry with increased building costs. A slowdown in the construction industry could have major implications for the labor market. A little over 11% of the male workforce is comprised in the construction industry. So if a slowdown in the construction industry in the U.S. materializes, you will likely see a deterioration in the labor market. In other countries, Canadian CPI figures are set to be released at 7:30 a.m. Central Tuesday morning. And economists are expecting inflation to rise at a level of 0.2%. Now, over in the UK, CPI figures are due Wednesday overnight, with yearly inflation expected to be at 3.3%.
JP, we haven't talked about the copper market of late. What's been going on with the U.S. copper market?
So the copper market's been in somewhat of a flux around the world as global manufacturing activity has declined. And more investors and producers are uncertain of the future as tariffs threaten to impact manufacturing. The copper market in the U.S. has been betting that a tariff will be imposed at a rate of 25%, matching those already in place for both steel and aluminum imports, after President Trump announced a probe into copper imports, citing national security concerns. The announcement resulted in waves of copper being imported into the U.S. in recent weeks in order to get ahead of any potential tariffs on the metal. The trade has been manifested in the premium commanded by CME's U.S. contract over the international price traded on the LME, essentially meaning that just 3 weeks ago, the cash premium between the CME contract and the LME contract was around $1,600 per ton. And now that premium is only around $600 per ton. So the sheer volume of metal arriving in the U.S. and the simultaneous drawdown of LME warehouse stocks is forcing that premium to narrow. Additionally, warehouse stocks at the Shanghai Futures Exchange has fallen considerably, with stocks of copper falling just below 70% since the end of February, highlighting just how, this potential copper probe has created a tight supply picture outside the U.S. And in contrast to foreign stocks, CME copper inventory has risen to an 8-year high, rising over 81% since the start of the year, at 168,000 tons of copper. The regional imbalances caused by the threat of this U.S. copper import have also affected flows of scrap copper from the U.S. to China. China is the main destination for U.S. shipments of recyclable copper. It imported over 440,000 tons last year, and the trade recently grounded to a halt due to uncertainty around a copper-specific tariff and the bigger reciprocal tariff picture. A growing mountain of refined metal in the U.S. is matched by accumulating supplies of scrap copper. The 90-day relaxation in reciprocal tariffs may free up some of this material, but for how long is dependent on whether the U.S. or Beijing can de-escalate the trade dispute. Additionally, expectations of copper surpluses are also stemming from an increase in global mine production, with global production expected to increase 2.3% in 2025. Additionally, the International Copper Study Group is forecasting copper surpluses to reach over 289,000 tons in 2025. Now, the initial optimism about the 90-day pause agreed by Beijing and Washington on most of their retaliatory tariffs has faded, with markets now focusing on the health of the global economies. For the Purchasing Managers Survey for May on Thursday will give more of an indication on the health of the U.S. manufacturing and services sectors. Investors will be keenly awaiting the report for any clues on the future of U.S. manufacturing and any hinting signs at copper demand.
Thanks, JP. Mark, The sugar market, where is global sugar production heading in 2025-26?
So this week, International Sugar Organization actually raised its forecasts for 24-25, increased the deficit to 5.47 million tons versus a previous one of 4.88 million. That was due to primarily to lower than expected production in India and Pakistan. But at an industry meeting last week in New York, produced estimates for a global surplus for this year, 25-26, anywhere from 400,000 tons to 1.53 million. So we've gone from a pretty large deficit to a medium to small surplus. They're looking, though, Brazil's production is expected to be up 4 to 5% from last year. India is up 22 to 24%, and Thailand's expected to be up 11 to 14%. But the Brazilian numbers, we're going to be watching those closely. They had a drought last year. They had to the point where they had wildfires that scorched some cane fields last September. So they're kind of on the bubble here, seeing if this production does come in as strong as some of these are expecting. We had that Unico report last week for Brazilian Center-South production for the second half of April, and that was down 54% from a year ago. And cumulative production down 39%. We're only 1 month into it. That may have been due to heavy rains in the second half of April, but again, we're going to be watching this. The other possibility is that if sugar prices stay low, we could see Brazilian processors crush more cane for ethanol than for sugar. And that kind of depends on the market for ethanol.
Lastly, Mark, coffee prices in the grocery store still remain very high. How is the Brazilian coffee market proceeding, and what does it mean for prices ahead?
Okay, so we are expecting at least some relief in supply, mostly due to the Robusta supply this year. Now, there's been a gradual increase in expectations for Brazil's Arabica crop. This is their off year. They have a biennial cycle, so this is the off year, so it's still expected to be down from last year, but they've been steadily revised higher recently. Safra Mercado, one of the reporting groups, reported a harvest had reached 7% of the planted area as of Tuesday, which was up 2% from the previous week, but below the 5-year average of 10%. Robusta harvest estimated 11% complete versus 16% a year ago. Arabica harvest 4% complete versus 7% at this point last year. So we're a little behind, especially possibly due to heavy rains particularly in the Robusta areas. Over the weekend, Bahia and Espírito Santo saw some rains, and those are Robusta areas. But as I mentioned, production forecast kind of edging higher. Over the weekend, Brazilian Institute of Geography and Statistics put Brazil's 2025 output at 55 million bags, which is a 2.3% increase from their estimate last month. They have Arabica production at 37 million bags, which is 3.5% higher than last month's number, still down 7.5% from last year. Again, we're in this off season, and less than ideal growing conditions last year. Forecasts, though, have been moving higher for the past month or two. Safra Mercado's Arabica forecast 40.46 million bags earlier this month, up from 40 million in April and up from 38.35 million in December. And likewise, CONAB, 37 million this month versus 34.7 million in January. One thing we've noticed, though, is sales seem to be off to a slow start. Overall sales, 16% of the expected output versus 20% a year ago. Arabica kind of close to last year at 22% versus still behind the long-term average of 31%. But Robusta sales only reached 7% of their expected output versus 15% a year ago. And that could be worth watching. This might be due to more competition from Asia. And if that pressures Robusta prices, we could see Arabica prices fall as well.
Thank you all. Remember, the views and opinions expressed today in this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.